Starbucks is not primarily in the coffee business. It's in the deposit business. At any given time, customers have loaded billions of dollars onto Starbucks cards and into the Starbucks app. That money sits there. It earns no interest for the customer. It does not require Starbucks to deliver anything immediately. Economically, it functions like a zero-interest bank deposit. In recent years, Starbucks has held well over $1 billion in stored value balances. That is more cash than many small banks control. Yet Starbucks is not regulated like a bank, and it doesn't pay interest like one either. That is the tension. People assume Starbucks makes its money selling $6 lattes at high markups, but a meaningful part of its advantage comes from prepaid balances and the float created when millions of customers pay in advance for coffee they have not yet received. The contradiction is not just surprising, it affects the company's cost of capital, liquidity, and growth strategy. Most customers think they are buying coffee. Economically, they are extending an interest-free loan. Starbucks generates tens of billions of dollars in annual revenue. Its operating margins are strong for a restaurant chain, often in the mid-teens in stable periods. But the real power of the model is not just pricing. It is the ecosystem that encourages customers to preload cash. The public narrative is simple. Starbucks sells premium coffee at scale. It benefits from brand strength and store density. It charges more than competitors and earns more as a result. The underlying reality is more structural. Starbucks built one of the most sophisticated loyalty ecosystems in retail. The mobile app integrates payment, rewards, promotions, and ordering. Customers load money into the app for convenience and to earn points. That preload behavior is critical. Once money enters the system, it becomes stored value. Starbucks records it as a liability because it owes product in the future. But until redemption, Starbucks controls the cash. That control has consequences. In banking, deposits fund loans and investments. Banks pay interest and earn a spread. Starbucks gathers deposits but pays no interest. The stored balances provide working capital. They reduce the need to borrow. They stabilize cash flow. In aggregate, they create a recurring pool of near zero cost capital. There is another layer. Not all stored value is redeemed. Some gift cards are lost. Some balances are forgotten. This is known as breakage. Over time, unclaimed balances can be recognized as revenue. That effectively creates margin without additional cost of goods sold. A bank cannot simply absorb deposits as profit. Starbucks can recognize breakage under accounting rules. The mechanism became clearer as digital adoption accelerated. As mobile ordering expanded, preload balances grew. The more customers rely on the app, the more likely they are to maintain a balance. The larger those balances become, the greater the float. This creates a reinforcing loop. Convenience drives prepayment. Prepayment increases stored value. Stored value strengthens the balance sheet. A stronger balance sheet funds more store growth and technology investment. That investment improves convenience, which drives more prepayment. At a certain scale, the hidden mechanism becomes obvious. Starbucks is not simply selling beverages, it is managing a financial relationship with millions of customers. Consider a traditional coffee shop. Payment happens at the counter, cash comes in, coffee goes out. There is no preload, no ecosystem, no float. Growth must be funded through retained earnings or external capital. Starbucks operates differently. It accumulates billions in advance payments across millions of customers. That scale alters the economics. This dynamic is especially valuable during volatility. Even if traffic fluctuates, stored value balances often remain elevated because customers maintain prepaid funds. That buffer stabilizes liquidity. It reduces reliance on short-term borrowing. It adds resilience to the model. The coffee business itself remains important. Starbucks has brand equity, purchasing power, and global scale. But the financial architecture layered on top of retail is what differentiates it. Starbucks has effectively turned a daily habit into a funding source. Stored value card balances appear as liabilities on the balance sheet. They represent obligations to deliver product in the future. Economically, however, they function as a revolving pool of low-cost capital. For a company with thousands of stores and significant capital expenditures, that funding advantage is meaningful. The alternative would be debt or equity. Debt requires interest payments. Equity dilutes ownership. Prepaid balances accomplish similar funding goals without either cost. This outcome is intentional. The rewards program encourages preload. Bonus stars are often tied to loading a specific amount. Promotions revolve around app usage. Once a balance exists, payment friction disappears. Customers gain convenience and rewards. Starbucks gains float and loyalty. The incentives align. The broader lesson extends beyond coffee. Many consumer companies now embed financial mechanics into retail experiences. Gift cards, subscriptions, digital wallets, prepaid credits. These structures pull cash flow forward. They reduce capital intensity. They increase customer stickiness. Starbucks is one of the clearest examples because of its scale. Describing Starbucks as a premium coffee chain is accurate but incomplete. Beneath the retail layer is a payment system built on recurring deposits, behavioral incentives, and embedded financing advantages. The comparison to a bank is not literal. Starbucks does not issue loans or hold insured deposits, but the economic similarity is clear. It gathers small sums from millions of people, holds them collectively, and deploys that capital within its operations. That changes how the business should be understood. It is not just a retailer competing on product and location. It is a platform managing liquidity through customer behavior. The coffee matters, the stores matter, the brand matters, but the stored value system quietly amplifies all of it. Once you see that mechanism, the business looks different. The green logo is not only a brand symbol, it is the gateway to a closed financial loop. And that loop is what makes Starbucks more than a coffee company.